If you're compounding at 25% for 12 years, that turns into a 14.9x. If you're compounding at 14% for 12 years, that's a 5. And public markets, which is 11%, gets you a 3.5x. So we don't look to early stage venture for early DPI. We have public markets, we have buyouts, and we have real estate, which provide different durations in regards to cash flow coming back. And it's important to have the proper mix of all those asset classes, because depending on what your ultimate investing mandate is for the family office, for the endowment, for the pension, whatever it is, you need to figure out that proper mix, because for us, we're looking to get those long-term steady state returns. And that's why 90% of your overall return comes from asset allocation, not individual investments, because it's due to those mixes.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Jamie Rhode is a principal at Verdis Investment Management, where she focuses on investing in venture capital, private equity, and hedge funds. Their portfolio, and correct me if I'm wrong here, it consists of 1/3 venture, 1/3 buyout, and 1/3 real estate. And Jamie, your team, I'm going to be honest, has one of the most impressive tech stacks in the LP world. And just to give an example of like what that tech stack looks like, it includes Salesforce, Airtable, PitchBook, ChatGPT, and you are building these things using Python and R, and we can get into all of this in the episode if we have time for it. But I'm impressed. Most venture firms don't even have this, right? And so I'm very impressed by that, and I'm sure our audience will be as well. We might get into code. I likely, realistically, will not get into the code part of this. But she and her team have a very unique angle driven by decision science for looking at the space as well. So I promise you, our audience, you'll understand why very, very quickly. Prior to Verdis, she broke into her data shoes at Bloomberg with tours of duty at BlackRock, Turner Investments, and PNC, as well as Drexel's Dragon Fund. And I know you have a couple of accomplishments over there as well. So Jamie, welcome to the show.
Thank you so much for having me. I'm super excited to be here. We love educating the LP base and, kind of giving back, especially, working at a single family office that's Gen 7, 8, 9, and 10. We've made a lot of mistakes, but, we're always learning and we hold our opinions loosely and want to give back.
There's one word you said in there that I'll seed this thought in our audience, and I'll see this thought in your mind as well. We'll get into some of the mistakes because I think those would be good learning experiences for our audience as well, because where you've already made those mistakes, they're probably making them for the first time, or hopefully they don't have to make it because they hear it on the pod. That's what we'll seed. So we'll also say we'll cover a multitude of topics, or at least I'll try my best to go both broad and deep with a priority on the latter. And naturally, given the constraints of busy schedules, because Jamie, you're incredibly busy, but also that we can't borrow our listeners' ears for longer than a commute to work during rush hour, I want to give the lay of the land. What we're going to cover, I'll do my best to cover, as well as what we're not going to cover, and it's just beyond the horizon. So you're not going to hear this in the pod, right? So what we're going to cover is we're going to cover your Wonder Woman origin story. And we're going to go deep on this as well. We're going to go deep on data because that's where you really shine. And because I'd be bonkers not to cover it as well. But specifically, I want listeners to walk out of this conversation with around, at least 1 to 2 kind of pieces of thought-provoking data that they can spend a few days pondering. On the flip side, what we're not going to cover who's in your portfolio. We're not going to cover why SF is awesome, because trust me, I can go on and on about this. Pineapples or no pineapples on pizza. Not going to do that as well. And we're not going to talk about what the hell happened in the fourth quarter of this year's Super Bowl. Okay?
Agreed. Please don't.
Perfect. I know we'll flip some scar tissue if we do that. So I want to start somewhere a couple of years back. I want to time travel to somewhere between 2011, 2015. I'll let you pick the specific timestamp there. But I have 2 questions here. One, you were at Bloomberg at the time as an analyst. What did your day-to-day look like there? And then 2, and you can answer it whatever order that makes sense to you. And 2, how did your experience at Bloomberg better help you appreciate the work you were doing at Verdis?
Sure. So I would say, the beginning part of my days at Bloomberg were just kind of first, just learning how to work at a large organization, which is an experience of itself. I had exposure to a lot of different departments, a lot of different geographical locations. In the beginning days, it was just kind of parsing through a lot of data. I think that's a typical job right out of college. You're kind of, doing data cleanup. You're trying to understand financial statements, and, the day-to-day duties of, joining the professional world. And I really realized pretty quickly that I enjoyed data, but I had, an intellectual curiosity side of my brain that wasn't being tapped. So I had moved over to the equity research team there. And that was about my last year and a half, 2 years there. And I covered property and casualty and life insurers. That was beyond boring of a sector. And what was exciting is when a hurricane hit. That's terrible. But the flip side of it is when you cover, the financial sector, there's a lot of data behind it, and you have to parse through a lot of financial information to understand those companies. And what I found most intriguing was we were publishing on the Bloomberg terminal. It really honed in on my writing skills. It really honed in on my research, and detail orientation was very, very important. And so I think, making sure that I kind of built those baseline skills of being able to write, being able to even speak there, to a larger audience. That is one benefit of working at a large organization. When you have to do presentations, there's a large amount of people in front of you. And also I was starting to learn how to, tap into that intellectual curiosity side of my brain and utilize it. But I'd say 2015 or so hit in the beginning of the year. I'd already gotten my CFA, and I was like, okay, I want to implement the skill sets that I had learned and turn it into actual investing and putting money where my mouth was, and learn how to do it. And it's really interesting because when I was studying for my CFA and I was doing this equity research, I was like, okay, academia is telling me to invest this way, or this is how you're supposed to analyze something. But some of it wasn't jiving, or wasn't making sense with me when, they're telling you, you should pick an investment off its Sharpe ratio. So return minus risk-free rate divided by standard deviation, the best Sharpe ratio is going to win. And I wasn't always seeing that playing out. And I was like, I need to dive deeper into this world. And I also need to find a job that a computer's not going to replace me.
I dig it. I have so many questions. Okay, I have 3 questions. We'll probably cover 2 of the 3.
Okay.
I will let you cherry pick which of the 3 that you want to dive deeper into. 1, what were you sold on back at Bloomberg that made you switch to equity research? Because you said this was the most boring job ever. These are your words, not mine. Okay, so I'm
yeah.
I'm sure there are plenty of equity researchers who might be listening to this pod, and I'm like, you know what? I haven't been outside that. I don't have the privilege of saying that equity research is boring, but you're it's interesting or exciting once a hurricane hits. What were you sold that made you switch internally at Bloomberg? That's one question, and I'm happy to go over this as well.
Yeah.
2, you said details really matter. Could you give us an example of what do you mean by details really matter? And then third of which is, what were you intellectually curious about? You said this was a fairly boring, so to speak, job role industry kind of thing. But it did spark your curiosity. So in what wavelengths did your curiosity spark in? So I'll let you pick any of the 3 questions to answer.
So I would say in general, I can kind of combine a few of them. What sold me about switching to equity research was that there was going to be, a senior or my boss kind of teaching me how to go through real life examples of financial statements and understand valuations of, individual stocks, and to understand, what I was really looking for is how to put the academic side to work in real life around how do I value an investment, and how do I know that this is undervalued, or this investment's going to grow, or I can make money off of this, and how does the actual, world work in terms of sell side and buy side. And so I was really looking to understand, the math piece of it, and, understand, is this undervalued or overvalued, and things like that. But what sparked me about it is it was a lot of writing. So it was a lot of analysis on a company and understanding a sector, understanding, a wide industry, and how there's different factors. It could be macro factors. It could be individual company factors impacting, a stock, and understanding essentially, what that meant and how you're putting all these pieces together. And so the sector was boring. I think if I was covering, retailers and I got to dive deep into Nordstrom or like Saks Fifth Avenue, that would be super exciting for me because at least I'm an end user of some of those products where like property and casualty and life insurance, like post college, I'm like, okay, I have an apartment and I do have a car, but like, that's more of like a steady state industry, which ironically, moving over to a family office who's a long-term investor, we're much more focused on steady state returns. So there was definitely parallels between the two, but I'd say it was the sector that was boring to me, but the underlying work and having to publish on the Bloomberg terminal every day where there's a lot of people reading it. And some of the work that we would do within the whole department worked with Bloomberg News. And so if you are posting something on the terminal that is not factual or is not accurate and you can't back it up, that's a problem. And people are making decisions potentially off of what you're saying. And so it was really important to make sure you're very, very accurate when you're posting things, onto the terminal.
Gotcha. So I imagine you double checked it, triple checked things. Your team members would corroborate to see like, hey, did you get to the right numbers? Did you look at the right data sources? That would make sure the layers of redundancy would help make sure the information is as accurate as possible. Am I right?
Exactly.
Okay.
Exactly.
That makes a lot of sense. So I want to fast forward a little bit down the timeline to 2016, 2017. You land yourself at Verdis. And when Verdis first pivoted, if I remember correctly, Verdis used to invest in fund to fund, some of your big name brand funds, multi-stage in nature, to investing in more emerging managers, sub $100 million funds, timeline wise, placing this correctly.
Yeah. So I can kind of go through the Verdis journey pretty quickly. I joined in 2015. And that's when we became a lot more data driven in nature. And we thought about revamping all the asset classes, not just venture. And our asset allocation is half publics, which includes a hedge fund portfolio, long only portfolio, fixed income and cash. And I'd say in 2015, 16 and parts of 17, we spent a lot of time revamping that portfolio and then moved over to the private side, which is a third real estate, a third buyout, and a third venture, which to your point, we were much more multi-stage in nature. We thought we needed big brand name access to get venture-like returns. And in 2016 is when we really started to go down this journey of pivoting to seed stage or funds that write the first institutional check into a startup.
I'm so curious because I read somewhere, and feel free to check my facts here because you've lived this and I've only read about this, and you can't trust everything you read on the internet. But the family gave you the ability to write checks into 20 small funds across 4 vintages, so 4 years, effectively 5 investments per year, roughly, right? And I know you and your team did your homework. And I have a question here. How did you let the world know you're open for business? Because you had previously not allocated nearly as enough or just not at all into smaller emerging managers. How did you let the world know, hey, you know what? We're now riding it.
Yeah. So in the very beginning days, it was really hard. I mean, we started this journey in 2016 and we did a lot of smile and dial. Like, we're a single family office out of Philadelphia. Like, who are we? And like, what are we trying to do? Front running Sequoia and Andreessen, SV Angel, and go invest in like Bay Area LA funds. Like, that was really, really hard. And so a lot of the initial work that we did was, building up some systems and platforms where we would parse the SEC website. So anytime there would be a Reg D filing, we'd be notified, and we would leverage social media, PitchBook, CB Insights, Crunchbase, anything we could just to identify anything about that fund manager. And if they fit the mandate of early stage, geographies and networks that we were targeting, and then we just reached out. So it was a lot of smile and dial. We did lean on some of the contacts that we had in the VC ecosystem, especially as you alluded to. In the beginning days, we allocated to fund of funds, and we leaned on them in some ways for introductions because most fund of funds don't invest in first time managers, and so they were helpful in market mapping, early stage with us and leaning on them to be like, hey, this family office is looking to meet with first-time fund managers or first check focused managers. And so that was helpful, but it was just a lot of smile and dial and just kind of putting ourselves out there and a lot of visits to Cali.
This is great. I promised I wouldn't talk about Cali. I wouldn't talk about SF. Actually, I'll talk about Cali because there's a question later on this as well. But what is the difference? What do you think in your mind are the ingredients of a great cold email versus a great warm intro? Because I imagine as the fund of funds is helping you make introductions, you're like, hey, here's a blurb for you to pass to this emerging manager. What goes into a great cold email / warm intro?
I think for a cold email, I try to be straight and to the point. If it's a long email, I doubt that they're going to read the whole thing. So I just tried to keep it quick and concise that, we're a single family office, outside of Philadelphia, and, we're looking to meet and invest in fund managers that are writing the first institutional check into a startup. And, I think that what's helpful is when you sit on the side where you have capital, people are much more willing to, respond back and take a meeting with you. It's definitely helpful. But, if you're an oversubscribed fund or if you're a somewhat brand investor, that doesn't necessarily mean you get access in the door. So with a cold email, it was always quick and concise and to the point of what I'm looking to get out of it and also what we can provide at the same time. But, anytime I think we receive warm intros, we prioritize, responding back to them.
That's fair. For the cold emails, was it an 80 to 100% response rate? Because you were coming from capital. I imagine people were just sure, we'll take the meeting. Even if we're not taking money, we'll take the meeting.
Yeah.
Was that true? Or was there some tweaks you made across the journey of sending cold emails that better refined the language so they can get a better, higher response rate?
Yeah, I think we had probably about an 80% hit rate or so. And I think I, evolved it over time, indicating that, we had been prior investors in venture and we were looking to shift to early stage, or, that this was, an email that was much more casual, 30-minute conversation. What really helped was, hey, we're going to be in town, especially back in 2016. Hey, we're coming out to California, willing to come to your office, want to meet. And that definitely helped, get a response back being we're coming to you. This is how committed we are to understanding early stage venture, and then indicating to them that after our market mapping that we were going to be allocating to venture, and that if we could prove our thesis out, or that, if we were successful, that we would be able to increase our check sizes going forward.
That makes a lot of sense. I mean, I think there's a huge underestimation of hunting for deals and being geographically present. I think the pandemic just shifted our minds of what is possible. Yeah. Now people are sitting back on Zoom calls and all that. And there's nothing wrong with that. You can access a wider range of the world of the US by just being on Zoom calls. But one of my friends recently, he had 2 competing venture firms who wanted him. And the one he ended up signing with, and they all gave him similar offers in terms of dollar size, right?
Yeah.
But the one he ended up going with happened to be the one who flew out to him. They flew out to him, and they treated him out to a dinner, whereas the other team just it was on a Zoom call. It's hey, great to know you. Let me know when you're in town, kind of thing. Yeah. And there's a proactive versus reactive approach to these things. And the folks who are proactive often win these deals.
Yeah, I would agree. We really had to put ourselves out there. And in the beginning, it was a struggle to find managers that looked the way we wanted them to look, I should say, or to fit the mandate that we were trying to invest in. And I got to be honest, in the beginning days, I was very concerned finding just 20 funds to invest in. And 75% of the funds we target are generalists and 25% are life sciences. And the life sciences bucket was really, really hard to find, early stage managers there. But it was definitely challenging, although I think we got lucky with the timing of things, because I think micro VCs were beginning to emerge during that time. And to be honest, the first 2 investments that we made were because we reached out to GPs that were either already spun out from another early stage fund, or the other one was we reached out to go invest in that early stage fund, and they said, hey, actually, I'm leaving and I'm going to go earlier than this fund and I'm starting my own. Do you want to chat? And I was like, great. Sounds good. And so I think we just got lucky with the timing. So, in the beginning days, it was a struggle to even get to 5 per year. But, I'd say in 2019 and 20, our network had already expanded enough and we were able to find plenty of funds by that timeline of, managers that fit the portfolio construction that we look for.
This might have been a while. I think this leads well into my next question. If you were to roughly say the percentage breakdown of, let's say, like cold outreaches, smile and dial versus warm intros, what would the percentage be in like year one of like hunting for your first 5 deals, like 2016, give or take? And what did that distribution look like by year 4, maybe like 2019, 2020?
I'd say 100% cold outbound in the very beginning. I think we had one fund manager, in the beginning days, some of these funds, they were fun ones and we backed them like the $15 million fund. And one of the fund managers was like, how did you find us? Like, how did you know that we were actually starting a fund? And like, there was times that my colleague and we would go and visit them and we were like, I hope this is a legit office. Like, we are just randomly going to show up to someone's office. Like, yeah, we spoke to them on the phone, but like, who knows what's happening? So, 100% in the very beginning days. And then I'd say like in 2019 and 20, it probably started to shift to a little bit more of like a 50-50 blend, largely because we already had a portfolio in place. And so, especially because we target managers that are very, very diversified and we're very geographically and network focused. So we would invest in funds that look like that. And then they'd say, I have another buddy that's doing this too. You want an introduction? And, to be honest, diversified managers have struggled a lot more to raise capital than I think more concentrated managers. I think it's a little bit of a contrarian approach. So, we started to build this reputation of being data driven and being very focused on a certain type of fund manager. And so that led to a lot of introductions and even introductions from GPs that we passed on because they were, say, sector focus and doing only 15 deals in the Midwest. We just do our very best to educate and explain, what our mandate is and why we focus on it. And, it's led to some great introductions.
And actually, out of curiosity, and like you touched on the diversified kind of component already. I know you've talked about this before, but for the uninitiated who believe in probably like everyone believes in like not everyone, I'm sorry, but a lot of people believe in the concentrated portfolio approach and they're like, hey, you should have like 20 to 30 investments per fund kind of thing. Could you walk us through briefly why Verdis really believes in the diversified approach?
Sure. So, and I think that this is a really important point too, because we're a single family office that's multi-generational. So we are multi-period investors. And we actually have a payout every year. It's 1.5% of NAV. And so from a mandate standpoint, we want to compound capital at the highest rate possible while the family can tolerate about a 10 to 15% max drawdown on a rolling 3-year basis. So we go through and have created an asset allocation based off that mandate. And so when it comes to venture capital is the asset class for us. That's the compounding machine. We deploy capital there and we're very multiple focused and we want to just compound that for a very, very long period of time. And so when thinking about that asset class, it's really interesting because it's power law distributed, meaning that mean return is significantly greater than the median. Unlike, let's call the public markets, which are normally distributed, where the mean return is very similar to the median. So if you want to outperform in the public markets, you need to pick and be extremely concentrated. And you need to pick properly. Because what's interesting is in the public markets, I can just go buy the S&P 500 ETF and be guaranteed to be in all the outliers every single year. I can be guaranteed. And you can't do them in private markets, but in the public markets, with a normal distribution, the only way to outperform is to be concentrated. So our long only portfolio actually looks like that, where we have managers that are invested in 5 to 10 stocks. Hold them for a long period of time. It's extremely volatile, but the benefit of that is that's a way to outperform the passive benchmark. A good example is during the GFC, one of our long only managers drew down 49%, where the S&P 500 drew down roughly 55%. Now, you have wicked behavioral biases kicking in that say like sell, 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 sell.
Right.
But that manager who's very concentrated, if you believe in them and you believe that they have the ability to recover from their drawdown, you stick with them. And that manager basically recovered in 2/3 of the time that the S&P 500 did. So net holding, which is hard to do in the public markets because you can always sell out, you're better off. In the private markets, in early stage venture, it's parallel distributed where that median return is pretty terrible. That's 50% of the population. So you have a 50-50 chance of getting the median, which is high single digits, where the mean return is about a 50% from 1990 to 2017 IRR. And so for us, we decided to target that mean return. We're looking to give the family the highest probability of compounding at the highest rate possible. And because we're long-term investors, that we want to target that. And we felt like we're looking for this steady state return. And the safest way to reduce risk is to go and be diversified, because that mean return is extremely attractive. And if you're diversified enough, it's really, really hard to lose all of your capital. If you look at the history of early stage venture on a rolling 3-year basis, the worst case scenario is a 1x if you got the mean return. So the rolling 3-year mean return over the full history, worst case scenario, a 1x, you get your principal back, and so that's why we target that, because it's really hard to lose capital in that scenario. But we also can provide the family the upside of capturing really good vintage years with a lot of outliers and potentially that mean return.
In public markets, you can sell whenever. And I've heard plenty of friends say in the private markets, illiquidity is a feature, not a bug kind of thing. But at the same time, when you're looking at venture as an asset class, getting some amount of distributions before the end of the fund is actually pretty good. Like most of the great fund managers, they don't wait till the very end until they start distributing cash, right? What would a good DPI, distributions to paid in capital, look like before the end of the fund? And at what point do you think fund managers should start thinking about it to give some kind of wheelhouse? Because everyone these days, I'm sure all these LPs listening to the podcast are like, we see TVPIs and IRRs in every single deck. And some decks have DPI, some decks don't have DPI, but I don't have a reference point for where I should be looking at some of these numbers. You live and breathe data. You see tons of data at this point. You're probably seeing a different sample altogether from 2016 till now, right? In your mind, or in maybe it's data informed, maybe it's just anecdotal. What does good DPI look like?
I love this question because it's very specific to what your LP mandate is, but I'm going to answer this in a way that we look at it. So that venture capital bucket is the compounding machine for the family. We don't look to that bucket for liquidity. When you look at the long-term steady state return for, let's call it the 3 asset classes that I have experience with at Verdis. So worked on the public market side in the very beginning. That long-term steady state CAGR, so your compound annualized growth rate, is an 11%. Also worked on buyouts. That long-term steady state compound annual growth rate is a 14. And in early stage venture, that long-term CAGR is at 25%. So if you think about that in terms of a fund life, let's call it realistically 12 years for early stage venture. I mean, we could maybe go out to 15, 20. It's a pretty long-term marriage. But, when you think about the compounding benefits associated with early stage venture, if we go out to 12 years, if you're compounding at 25% for 12 years, that turns into a 14.9x. If you're compounding at 14% for 12 years, that's a 5. And public markets, which is 11%, gets you a 3.5x. So we don't look to early stage venture for early DPI. We have public markets, we have buyouts, and we have real estate, which provide different durations in regards to cash flow coming back. And it's important to have the proper mix of all those asset classes, because depending on what your ultimate investing mandate is for the family office, for the endowment, for the pension, whatever it is. You need to figure out that proper mix, because for us, we're looking to get those long-term steady state returns. And that's why 90% of your overall return comes from asset allocation, not individual investments, because it's due to those mixes. So if I'm going to give the family that long-term CAGR of a 25%, that's going to be a significant contributor to their overall portfolio. I'm not worried about the individual one-off fund in there. It's more, am I diversified enough investing in each vintage year to get that 25%? Now, this is a long-winded way of saying, if I said to my GP, you know what, it's year 8 and you have 0 DPI, I'm angry. The other side of it would be, let's actually look at the math of it and say, okay, if you think about that long-term steady state return of 25%, what's really important is the last 20% of time produces 46% of that return. So I said at year 12, compounding at 25%, I would be at a 14.9x. So if we sold out earlier, so I said the last 20% of time produces 46% of that return. So if we sold out at year 9.6, my multiple would probably be what, an 8.5x or so, something like that, 9. So selling early in an asset that's compounding at a high rate is actually not something that we're looking for. The DPI piece of it early, if it's an asset that's compounding at a low rate, or it's a mediocre exit or something like that, that's fine. And at the end of the day, I do want my money back at some point. But if the asset is compounding at a venture-like CAGR, don't sell out early, because you're missing out on a huge part of that ultimate multiple. And so for us, we're taxable investors. I have to go pay taxes on that asset that you sold out of early, and then go find another asset compounding at 25%. So I think if the venture portfolio is not being used for liquidity purposes, where if you're investing in seed stage, it really shouldn't be used for liquidity or IRR. That's the purpose of other asset classes. You shouldn't be worrying about, early DPI. I think it's always important to have it compounding at a very, very high rate.
There are like a million cases out there, and edge cases, outliers to quote unquote this rule. I'm actually curious about something. And this might be a rookie question, but I take this podcast to ask rookie questions.
I love it.
If an asset, like let's say a portfolio company, is growing at a faster than 25% a year kind of benchmark, so maybe they're growing 30%, 35%, that's probably a reason not to sell, because they're only going to get better over time. That said, if there is a portfolio company that's growing at like 20%, 15% year over year, but you believe they're highly valued because of who knows what, like 2021 or whatever it is, right?
Yeah.
Is it smart for an investor in that situation to think about distributions because that asset may be overvalued compared to how fast they're growing?
I think, and we've seen cases too where some of our GPs have taken some chips off the table. At the end of the day, you guys have to fundraise. I totally recognize the benefits of showing early DPI when it comes to having to raise another fund. I understand the real agency issues in this industry. So taking some chips off the table, we've seen. I think the ultimate answer comes down to the opportunity cost. So if that asset is compounding at, 20%, still the last 20% of time produces 40% of your return. But if you think that it's reached its ultimate end terminal value or its highest terminal value in the full life of the company, then it's okay to sell. You've probably backed this company since day one, and this might be year 6 or 7 or year 10, and you have probably pretty good knowledge on, where can this go from now? And if you feel like it's reached its maximum valuation, then absolutely sell out. Or if you have some insider information that this thing's going to go south really soon, totally sell out. But just think about, the opportunity cost associated with that. And what I think is the hardest part about investing in venture and having to make decisions is it can be somewhat easy to know at some point, even maybe let's call it Series A, this company is going to turn cash flow positive. They have a good chance of being profitable. they're going to be successful and they're likely not going to die off. But what's really hard is what is going to be the end expected value? What is it going to be worth 8 years from now? This company could be successful, but does success mean its terminal value ends up being 150 million, or does it end up being 150 billion? And I think that's the hardest thing to know, is especially when these GPs are following on into Series A, Series B, and Series C, are you making that decision with the thought about, my capital is being deployed at a later stage into more expensive rounds? Should I be taking that capital, investing it in another seed investment at the first check, increasing my probability of capturing a $150 billion exit?
That makes a lot of sense. And that is why, and it's not a hard and fast rule, but I believe that is why Verdis looks at funds that don't have reserve strategies.
Exactly. Well,
okay.
I prefer low reserves, I should say. Our big philosophy here is hold your opinions loosely. We have a mandate and we have a focus, but especially in early stage venture, the outliers come out of the tail. So we have to hold our opinions loosely.
So speaking of holding opinions loosely, were there things you've changed your opinions on back in, like, you had them in 2015, but you no longer hold them because you've had data prove you otherwise?
I think that before I joined Verdis, or even in the beginning days, I thought that investment professionals had the ones that were successful had serious skill. I thought that there was hedge fund managers out there, or VC funds, or buyout funds, or real estate, like any asset class. I thought that there was a subset of managers that could truly pick and they had skill. Now I question if anyone has 100% skill. Like, if you're successful, was that luck or was that skill? And how do you discern between the two? And I think that, just from over time and taking a lot more of a data-driven approach, and to be honest, making investment mistakes and having them show up right in front of your face, I think that the biggest lesson learned for me of my time here is recognizing that investing is a sampling exercise and you have to use math and probabilities to your favor. I rather play the odds to my best advantage than underwrite someone thinking that they have skill. Because I think at the end of the day, if you were super successful and you picked, 5 stocks in your portfolio day one and they just shot up to the right, was that luck or was that skill? Because sometimes you can pick a stock and have your whole thesis be accurate, but at the end of the day, something at a left field happens, like a COVID or, a hurricane wrecking houses. And then all of a sudden, your underwriting thesis is out the door. I think that it's really hard to pick managers based off of an assumption that they're 100% skilled.
That makes sense. Do you ever explicitly ask managers, how much do you think your success so far is based on skill? How much do you think is based on luck? Is that ever a question you ask managers?
In the beginning days of going through this journey of investing in early stage venture, we target fund managers that are diversified. So the perfect fund for us is 50 deals and low or no reserves. And the 50 comes from the average outlier production rate in early stage venture is 2%. So 50 times 2, if I'm underwriting to pure randomness, I get an outlier. So when we started talking to GPs and said we're targeting more diversified portfolio and provided an explanation in the beginning days, they got very offended because they were like, what do you mean? I don't have any skill? I can't pick? Didn't you see in my last fund that I picked an Uber or whatever it was, or Facebook? And so then we'd be like, okay, well, if you can pick, why aren't you only doing 5 investments and all of them being winners? And so then we learned to smooth out that conversation and just kind of explain it in a way that, what we're looking for is GPs at the same time to also play the odds in their favor. And if you really are having strong deal flow, why aren't you doing more? Why are you turning it down? And why are you following on into Series A and B if the math that you should be doing shows you that the multiples at seed are higher if it's successful? So I don't think it's a question of do you think you're skilled or lucky? I think it's just a question of let's walk through what your long-term vision is for your firm and your brand. And does that align with how you're deploying it today? And does your thinking about how venture work align with ours? Because it is a marriage.
As an LP, I think a lot of it is how do you approach the conversation in a way where people stay open-minded and curious? And it's not necessarily attacking their ego, but it's having them question it themselves to be more self-aware.
Everyone needs a baseline skill set at some level to become a true venture manager, to become a true investor. So I don't want anyone to think that I don't think anyone has skill. It's just there's a baseline skill, and then above that, how are you approaching it?
Okay, I have another question. There was one word, the word count is of one, that you mentioned that I thought was too good not to pass on. You mentioned that, let's say in a portfolio of 50, if you're betting on venture as a generalist, you have a 2% outlier rate. The word in which you used was outlier and not unicorn rate, right? And I think most people, I speak from VCs standpoints and GPs and all that, they usually categorize like, oh, these are the amount of unicorns that hit unicorn rate. And they're not mutually exclusive, those words, outliers and unicorns. In your opinion, and at Verdis, like how do you define what an outlier is, and why is the outlier nomenclature so much more important than, let's say, using the unicorn nomenclature?
So I think it's because it's very specific to geos and networks and sectors. So in therapeutics or life sciences, there's a 10% outlier production rate there. And outlier in therapeutics is not $1 billion plus. Typically an outlier is somewhere between 500 million and $2.5 billion. And so it's important to classify life sciences outliers with a different expected value than our general tech managers. And internally, we've built models. So when we identify a fund manager that we're interested in, we'll put their portfolio construction into our internal model and we'll change the EV or the expected value of a winner. And so if it's life sciences, that's totally different. If it's a manager that is 100% California, if you look at the outlier production rate of California and you look at all US, let's call it unicorns, $1 billion exits in California and the US as a whole, California produces 60% of all the US unicorn exits. And their expected value is $9 billion. So if I have a GP that's 100% California, that does include LA as well. If it's 100% California, their EV, I should adjust to $9 billion. Now, if I look at New York, for example, they produce 13% of all exited unicorns and their EV is $5.8 billion. If we are investing in a GP that's 100% YC, they have a different outlier production rate and a different EV, and we blend them as well. So I think in general, any company that's $1 billion plus, we're going to call an outlier, we're going to call a unicorn, but we internally will underwrite a manager and make adjustments based off of where they're deploying their capital, whether it's geo or network focused.
That makes sense. I want to say, and speaking of YC being such a great sampling, I want to say they have like a 6%, and I'm going to use the word unicorn because I think
5.5, something like that.
6.
Yeah, it varies.
And so and to just qualify that, out of every 100 startups, 5 or 6 companies end up going to that $1 billion status. And that's just, they really truly believe in this diversified approach, because if you look at the amount of the class size of YC, every single year or every cohort, it is massive. It's in the magnitude of hundreds. Really what's really interesting for outliers as a whole is the way GPs pitch. It's always unicorns, right? And when it comes to outliers, what do you look at, right? Do you look at the schedule of investments? Do you look at just give me your entire portfolio and we'll plug this into our model? Or is it based on what they're cherry picking and putting on in the slide deck? I get really nerdy about this technical side of things, but how does that work?
For us, outliers don't truly emerge until 8 to 10 years after an investment. So a lot of times we get GP decks, and we've backed fund ones before, and maybe you did catch the Uber. skill or luck. I have no idea, but use that investment to your advantage. And maybe that lucky investment that you made helped you build out a network. And now you are able to access certain deals or certain cohorts of startups, whatever it may be. But what's more important to us is if you can show us where your network is. So when we find a manager that we like, everyone looks at performance. Like, let's be honest. You're not going to not look at performance. Like, come on, we're all investors at the end of the day.
Oh, yeah.
But what we'll do is we'll ask them for their track record in regards to their co-investors and their follow-on investors. And if it's limited and it's just an angel track record, that's fine too. And we'll overlay that into our existing portfolio. You could be a manager that does 50 deals and no reserves, but if you provide me exposure to the exact same pool of startups that another GP of mine does, then unfortunately, you don't have proprietary deal flow for me. You don't enhance my network diversification. And so we would pass on that opportunity. We may keep them on the short list because just because we invest in you does not mean we're going to re-up with you. And we hope to, but if you change your portfolio, you strategy drift, we're going to back off. And so it's really important for us to look at their network access and where they're planning and where have they deployed their capital to make sure that it's going to enhance our portfolio diversification that we're looking for.
How often do these reviews happen? So let's say like a fund manager in which you backed comes back to you. And I want to say the percentage breakdown, and once again, correct me if I'm wrong here, is you do 70% re-ups into your existing managers and then 30% into new GPs. How do you make that decision? Like, I don't want to belabor the term, but who gets like kicked out, right? Like, is it always a drift in strategy, or are there other reasons that one may graduate from your portfolio?
Behavioral biases are so real. It is so hard sometimes when you've backed managers from early days and you have a relationship with them to stay very focused on what your mandate is. So that's really why we try to take this more data-driven, quantitative approach up front to any investment. And so the 3 re-ups that we've passed on were due to one going from a generalist to a sector specialist, one, building a larger fund where more of the capital was being deployed at let's call it Series A and B. So a big thing for us is if your fund size grows and it's bigger, that doesn't necessarily mean you're a no, but how are you deploying that capital? If 90% of it is still being deployed at pre-seed and seed, and you're a $250 million fund, you are still truly a seed stage fund. But if you are a $100 million fund and 60% of your capital is going in at Series A and B, you are now a multi-stage fund. So it's just important for us to peel the layers off and see where that capital is being deployed and how it's being deployed. Also, we're not huge fans of any type of staple requirements, or if you're going to raise a seed fund and a growth fund at the same time. It's a big lesson learned for us too over time, just to educate the GPs as well about this is our mandate and this is our long-term mandate. So if you have visions for building, your firm to be more multi-stage focused or to offer multiple funds and you're going to require LPs to commit to all of them, it's on us to tell them that's not going to be a fit for us and maybe we shouldn't engage in a relationship in your fund one. We'd like to back you. We'd like to support emerging GPs, but we've begun to tell GPs in the beginning, this is what our mandate is and this is what we're looking for the long term. So the information is at least out there.
When you share what your mandate is, it makes it easier to say no, because it's not like, it's not the, what is that usual breakup line? It's not you, it's me kind of thing. It is very true, because then you know exactly what they know exactly what you're looking for. And because of that, they can self-select themselves into it. It's like, my strategy does fit. My strategy doesn't fit. My follow-up question to that is, how often do managers go like, but I'll be the first one. I'll be the first one in your strategy. Like, this is going to be a new thing. Maybe it's worth exploring our relationship further. How often does that happen?
A lot. I mean, there's a lot of conversations with GPs that try to change our mind, but at the same time, we have conversations with GPs and give them our background and philosophy of why we're targeting this type of strategy. And we also try to change their minds too. But at the end of the day, GPs need to deploy their strategy the way that they love and the way that they are passionate about and believe that will last long term. Don't do something because one LP with a check in front of you says, if you do this, I'm going to back you. Stay true to who you are. And I think that's important for LPs to push GPs on that, to understand, where they're going to fall out in the future. But I think that we've had a lot of GPs that very much disagree with us, and they've led to actually the most fun conversations when you sit on opposite sides of the aisle. It's really important to avoid groupthink when investing. Following the herd is not always the best decision. And so we do like to have those types of conversations, but at the end of the day, we have, a process in place and a mandate, and we have to fall back on that.
And this might not be the best analogy, but an analogy I thought of just now might be helpful. It's like, hey, let's say you wear like size 10 shoes, right? And that is the shoe size in which you wear. But then you end up talking to a basketball coach, like, hey, everyone on our team is like size 15 shoes. And, if you wear size 15 shoes, like we may consider you to be part of like our basketball team.
Yeah.
You're not going to wear a size 15 shoe if you're a size 10 shoe, right? It doesn't fit. It may like be like, oh yeah, now I can start playing. But then you're like walking around these oddly shaped things. You're going to have foot problems. Your arches aren't going to be as great. Like, all these other problems that come from that. And I want to say that that's a pretty similar standing of like GPs, yes, their thesis and what LPs are looking for.
Absolutely. It may take you longer to fundraise, but, stay true to who you are. And LPs need to do that too. I think for LPs that are investing in any asset class, but specifically venture capital, it's really important to consistently invest in each vintage year and to make sure that you are not overweighting or underweighting a specific vintage year, because outliers emerge during all time frames. And it's important to have a prudent deployment strategy. And I think we look back on our buyout portfolio, and in the beginning days, we were lumpy in deployment. We invested in smaller buyout funds. We thought they could outperform. And what the end result is by not being consistent, it means the distributions are also lumpy. And so for us, we don't have external cash flow coming in. And so we need distributions to fund future capital calls. And so I think it's just very prudent to always be consistent in your investment approach and try not to make, tactical decisions, especially the way we invest. The power law is going to work in your favor. There could be a couple vintage years that suck, but it's going to catch up as long as you're consistent. I think going back to the skill versus luck, where you see persistence or skill or whatever you want to call it in early stage venture is the GPs that are consistent with their strategy, always investing in early stage venture at a general similar pace per vintage year. That's why persistence exists, because they haven't jumped up in fund size and changed their strategy and doing half the number of deals that they did the prior year.
It reminds me of this, I think it was a Seneca line or something. Opportunity is, I think it's opportunity is when luck meets preparation. I think that's where it stands, right? And preparation is what one might call skill, and luck is luck. But you're trying to increase the surface area for luck to stick, and skill is obvious in hindsight, but rarely if ever in foresight. And for you, it's for other folks, you might tell yourself a story, but it's really hard to show that past performance is indicative of future performance, if at all. That makes a lot of sense. Okay. As we're getting into the fourth quarter of this kind of like podcast, I want to talk about California. I'm biased to California. I love California. I had Chris Duvos at Ahoy on, not too long ago. And he says California is just a very special place for founders to come. And I actually learned this from Chris. But California is one of the few states in the US where non-competes cannot be enforced. And that's just like a fascinating point to me, because it's like, well, startups can like come out and like this is why like Silicon Valley or LA becomes such a concentrated geography of companies, because you can do literally whatever under the face of the sun. You're not beholden to like 1 to 2 years of not being able to do a competitive thing from your last employer. So structurally, This allows California to have more surface area for outliers to stick effectively. And so one thing that I ended up realizing is I was listening to your episode with our mutual friend Paige Doherty's, and of the 20 funds you invested in at the time, you mentioned there that 1/3 were geographically based in LA. And you and your team have been fascinated by the LA geography as well since the very early days, right? And equally so now, there are many rock star firms there. There's Upfront, there's Mucker, there's Crosscut, just to name a few. But I'm so curious, what fascinates you about the LA geography? And when did you first realize the city of angels is well positioned to outperform?
It was the weather. Let's be honest. I mean,
okay.
Beach.
I'm in the wrong geography
weather,
here.
I'm out. I just wanted to go.
Why are you still in Philly? You just mentioned before our chat that's humid. It's
die-hard Philly sports fan. I cannot join the Cali Queens over there.
So sports is more important than weather in your priority stack.
That's true.
Okay.
That's true.
I'll give you that.
I'm going to go back and say that was a bit of luck, the LA call. And we made our first two commitments were a Bay Area fund and an LA fund. And at the time, we kind of thought LA a little bit, mainly Bay Area. And I will still say Bay Area was priority number one and still is today. But, the Los Angeles ecosystem at the time, and this was back in 2016, when we were beginning our market mapping exercise, it is home to several world-class research universities. It produces a lot of startup talent. It was at the time, and I'm not sure if the rankings change constantly, but at the time it was the third largest market for unicorns. But the top 10 VC funds in the region had less than $1 billion in AUM. So that market had a lot of high potential with a relative lack of investor attention to LA. Now, for us coming from Philadelphia, an LA to Bay Area flight is super short. I know at the time that a lot of Bay Area funds were like, I'm not flying down to LA. Are you kidding me? But when you started to market map the talent that was being produced from that region, and then the VCs that were actually local, there was a mismatch. We felt like there was this type of arbitrage opportunity that was happening, and we had identified just a couple LA-based funds. And so for us to feel comfortable with making that LA call or investing in seed funds that invested in startups there, the biggest challenge for us was, can these seed funds get their startups follow-on funding? I mean, the market for seed, or let's just call it early stage at that time, because, there was some Series A funds there, not many, was starting to emerge, but there wasn't a lot of them. And so our biggest question was, can these GPs get their local startups Series A, B, C funding? What happens when they get to the later stage? And so a big part of our due diligence at that time was validating that those GPs had relationships with the later stage funds and could get them that late stage funding access. That was the biggest piece there, because there was emerging, unicorns coming out of there and a lot of talent, but there wasn't a lot of capital. And I'd say, you've seen a lot more outliers emerge from that region. There's still not as much capital there as Bay Area, but it's an ecosystem that we truly, truly love. And I love the weather.
Weather's great. Business trips there are awesome.
Yes. The traffic is terrible, though. No, I couldn't live in LA. The traffic, absolutely not. No.
I'll keep that in mind. Okay, we're now in the last quarter. This has been so fun, and I like one of the great things that I want to do in this podcast, or I don't know if it's self-promoting to call it great, but I really wanted to highlight the humanity behind the face of LPs in this world, because too often, whether it's GPs or just investors in general, they kind of highlight LPs as a collective audience. It's everyone is just an LP kind of thing, right? And when we get into this last two questions, one of the things I love doing is just I want to talk about you. Okay, we've talked about Verdis, we talked about your investment strategy. Hopefully somebody learned something great from the past hour.
Hopefully.
And I definitely, but I was taking notes. I don't know if you could tell. I was taking notes on the side. And I don't know why. I have this all recorded. I have show notes for this and all that, but I'm still taking notes. Anyways, so most people in the LP landscape tend to have a phenomenal resume. and you can find all the ways they shine on LinkedIn or on their one pager. But I've always been a fan of the antithesis and actually what I call the anti-resume, right? I used to have one, I still have one myself. Like I have one where it highlights all my biggest failures and professional mistakes. And that is a resume purely for that. There's no glamour in that. So I'm curious, what was a time you made a mistake or a bad professional decision in hindsight?
Sitting on the investment team, you see a lot of investment opportunities. And, when you start building out a portfolio, you meet new GPs, especially when you have a clean slate, you get super excited about certain opportunities and you want to make investments and things like that. So there was a GP that we invested in, and we were all super excited about this unique opportunity that we were, doing a bunch of work on. And we thought that the opportunity set was ripe for investment. And so we made an investment, and we had thought we understood who the other investors were. We had done reference calls and we had made an understanding of, who else was going into the fund. But what we didn't specifically get on paper was official hard commits with subdocs signed, sealed, and delivered. We had thought we knew it, but they were more soft commits. The subdocs were not signed, sealed, and delivered. We were one of the first to go in, and we did not think we were one of the first to go in. And so this was right also around the time of COVID hitting. And so there was a lot of things happening all at once. But at the end of the day, we ended up investing in this fund, and they were significantly below what their target was. And, that was on me. That was on my team as well. And, we now sit on their LPAC, and that's never something we do. We don't sit on LPACs unless it's a problem child. And that fund could actually potentially hit it out of the park and crush it and be the best performer out there. I have no idea if that's going to end up happening. But, that was on us to not do enough due diligence to make sure that we're not investing before they hit their minimum viable fund size in hard commitments. I mean, that fund now sits probably, they closed, I want to say, 90% below target, because a lot of people had pulled the subdocs that they were actually going to send in, because of the COVID situation. But, at the end of the day, we were left holding the bag with a couple other LPs. And so that was a mistake on our part that, they could be super successful and it could end up working out. But I'm not going to know it until 8 to 10 years from now, because that's how long it takes for an outlier to emerge. But that was an error on our part where, we didn't do enough homework back. And that was in the beginning days. But, it was a great lesson learned for us to make sure that, we're not committing to a venture fund until they've hit their minimum viable fund size in hard commits, not soft.
Okay, well, hopefully I'm going to cross my fingers, and I think this is very much going to be the case. But in 10 years, I'll have you back on. We'll reevaluate that fund, and we'll see if it was.
You know what I will tell you about that fund? I have gotten DPI from that fund talking about early DPIs, so it's possible,
It's highly likely. Okay. Last question. We've talked about things where you will not budge on. We've talked about, some potential decisions that may have deviated from what you hold to be true. I'm curious, what is one unique thing a GP has done to win you over in the past, where you were on the fence about it, you weren't too sure, but they did something, and you're like, you know what? Maybe we should just trust our gut here and we should go with it. Has there ever been a time like that?
I would say there's two key things that you could probably do to, win me over if I'm on the edge of it. One of them is, just like us, hold your opinions loosely. So we have talked to GPs and emerging managers for long periods of time. And what they've done is taken the feedback that we've said, and they've actually made adjustments to their investment portfolio because they've processed what we said and used the math to their benefit, playing the odds to their favor, and adjusted their strategy and have said to us, even if you don't commit, I'm still going to have adjusted my strategy to less reserves or more deals up front. And so I think that's really, really, important. And having the ability to be humble in this industry after extreme success is some qualitative factor that I process and view as a positive. I have no idea if that impacts performance or not, but being humble and kind is not that hard to do. And I rather back a humble and kind venture fund than someone that is not humble and kind, if all things are equal. The second piece of it, I would say, is prioritizing reporting. I think that, a big challenge for emerging managers is understanding, what your LPA states and, are you going to get your tax reporting done on time, and having the ability to say, I'm going to prioritize the operational piece of my business because, we at the end of the day have to file our own taxes as well. So if that GP is late, then I'm potentially late on my tax reporting, and it's a whole trickle down effect. So when the GPs talk about the importance of non-investment pieces of their business, that's an indicator to me that you're thinking that you're institutional in nature and that you're looking to build a firm and a brand, that you're not just looking to invest.
That makes a lot of sense. Actually, I lied. I'm going to ask one more question, but it's going to be a quick one. When does Verdis like to receive their tax stocks? Like, when should LPs be looking to receive their tax stocks? Obviously, there's the hard set date, but obviously you need time to process all of it.
Yeah.
When do you like to receive them?
Okay, so typically in an LPA, it says that they're going to have their K1 or tax reporting done by March 31st. There's been real life examples that we haven't seen them until August. Our Verdis tax filing deadline is September 15th. So if we talk about our first iteration of our seed program, we had invested in 20 funds. And so for us, for that 20 fund entity, we have to get all 20 K1s together, pull all that data into the entity, compile our investors' tax information, and then give it to them. Some of our investors are trusts, and so they have to file their tax returns by September 15th. September 30th. We have to file the tax return by September 15th. So Verdis has to give it to the investors by September 15th. If you're a trust, you have to file your taxes by September 30th. If you're an individual like me, and I'm lucky enough to be able to co-invest with the family in all of our venture funds, I have till October 15th. So if a VC fund manager is going to be late, communicate it and tell us, that I'm going to be way past my March 31st deadline that the LPA states. And that's okay. Mistakes happen, but for a trust, they have to file by September 30th. For an individual, it's October 15th. And for Verdis, it's September 15th.
So helpful. I need those dates for the eventuality for myself, but that's in the future. Jamie, it has been such a pleasure. I've learned so much from this conversation. I know our listeners will as well. If they want to find you, and I know you're out there in the socials, you're out there with the email and all that, but where's the best place? Let's say people have questions, LPs have questions. Where do they go for you? 100%
LinkedIn. I would absolutely say you can find me on LinkedIn. Send me a request and tell me you're an LP. Higher probability I accept. No, I'm totally kidding. But definitely,
and you'll have GPs just saying I'm an LP as well. There's a lot of GPs these days. I've talked to a lot of emerging managers who are also LPs in other funds.
And I will tell you as a quick note to that, sometimes we view that as a positive indicator. So if there's an emerging manager and there's other GPs that are LPs in that vehicle, that could necessarily be a positive thing that we look for and say, great, deal flow for each other. So holler at me at LinkedIn and I will totally respond to you. And I will tell you also, follow our LinkedIn page and my colleague Steve Kim's LinkedIn page. We post a lot of data geeky fun things.
I can verify that. Jamie, it is such a pleasure. As you know, we've had probably 50 more questions to ask, but as all good conversations go, we run out of time before we run out of topics. It's been an absolute pleasure. Thank you for being here.
Thank you so much for having me. I loved it.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are two completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for two reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist. And I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up. And as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of: LaunchDarkly, Prevacera, MoEngage, and we're also backed by some incredible LPs and investors, including Khosla Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers, and if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and at the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.